It's a funny thing about modern life. You wake up on a mattress manufactured by a company owned by a private equity firm.
Right, yeah.
You check your phone, interacting with cloud software that was scaled up by private equity.
Mhm.
You might even go to a clinic or a hospital that was recently restructured by private equity.
Oh, absolutely. It's everywhere.
Right. And yet, if someone stops you on the street and asks, well, what exactly does private equity do? You'd probably picture I don't know, a shadowy boardroom, some ruthless Wall Street types, and a lot of companies just being aggressively scared for parts.
Yeah, it's an incredibly polarized caricature. I mean, private equity is typically viewed through one of two really extreme lenses.
Right.
It's either this flawless, magical engine of wealth creation that's completely reserved for the ultra-rich, or it's the ultimate villain of modern capitalism, just ruthlessly destroying local businesses.
Like the Gordon Gekko stereotype.
Exactly. But the reality is, well, it's far more nuanced than that.
And that is exactly why we're doing this. Welcome to a brand new deep dive. We are drawing on an incredibly comprehensive book today called Capital in the Shadows by Nishant Prabhakar.
It's a fantastic resource.
It really is. And our mission for this deep dive is to basically peer inside the black box of private equity for you and get past all those caricatures. Because what this book reveals is that PE is not just a bunch of spreadsheets and financial engineering.
No, not all.
It is a deeply human, highly complex system of capital allocation that practically shapes the world you live in.
At its core, private equity is fundamentally about taking responsibility for a company. I mean, it's about pairing capital with active ownership to transform a business over, say, a 5 to 7 year horizon.
Active ownership being the key there.
Right. It's not passive trading where you just buy a stock and, hope the line goes up. It is very hands-on, roll-up-your-sleeves business architecture.
Okay, let's unpack this. Because if we really want to understand the actual mechanics of the industry, we have to look at where this all started. And I have to admit, I kind of always assumed private equity was a completely modern Wall Street invention.
Most people do.
Right. You think of guys in the 1980s with red suspenders inventing the leveraged buyout over a martini. But the book traces the actual blueprint for this industry back centuries.
Yeah, the fundamental impulses of private equity, pooling capital, taking calculated long-term risks, and active stewardship, those are older than modern banking itself.
Wow.
We can actually look back to the medieval Italian merchant guilds, like the Medicis.
Wait, the Medicis?
Yeah.
Like the Renaissance family?
The very same. They were deploying capital into these massive trade expeditions and mining ventures that traditional moneylenders wouldn't even touch.
Because it was just too dangerous.
Exactly. The risk of failure was just way too high for a normal bank.
So the wealthy merchant funding a risky 15th century spice voyage was basically the world's first venture capitalist.
That's a great way to look at it. If we connect this to the bigger picture, public markets and traditional banks have always demanded predictable, steady cash flows.
Right, they want safe bets.
A bank wants to see collateral. They want to know you can make your monthly interest payment without fail. But humanity had to invent a parallel system to fund bold, highly uncertain, and transformative ideas.
That makes a lot of sense.
Yeah, and you see this institutionalized later in the 17th century with joint stock companies like the Dutch East India Company. They were pooling massive amounts of capital for these transoceanic voyages.
Right, the spice trade.
And the returns were nonlinear. Many of those ships just sank or were lost to pirates, which meant a total loss of capital. But the ones that returned with spices paid off exponentially. It's the exact same power law distribution we see in early stage investing today.
So we jump forward to the industrial age, and suddenly it's not ships anymore, it's trains. The book describes J.P. Morgan stepping in, not just as a traditional banker, but acting like an early buyout specialist.
Oh, J.P. Morgan was a master at this.
He was looking at these failing, chaotic railroads, and he was stepping in to consolidate them, installing entirely new management teams, and just completely fixing their debt structures.
He essentially demonstrated that financial discipline combined with operational restructuring could save distressed enterprises. But the true birth of modern venture capital, like as a formalized industry, happened right after World War II.
Like 1946, right?
Right, with a firm called the American Research and Development Corporation, or ARDC.
I read about their legendary investment in the book, but I gotta say, the numbers almost look like a typo. They put money into a startup called Digital Equipment Corporation, right?
Yeah, they did. They invested $70,000, and over time, that $70,000 grew to over $350 million.
That is absurd. I mean, it completely blows public market returns out of the water.
It really does. And it proved to the financial world that institutions like pension funds and university endowments should allocate a portion of their portfolios to these long-term, illiquid private investments.
But finding a startup and hoping it turns into a unicorn is very different from buying a massive, mature company like Dunkin' Donuts or Hilton Hotels and trying to generate a massive return.
Oh, completely different game.
To do that systematically, the industry had to develop a very specific way of figuring out what a complex business is actually worth. Which brings us from the history books to the calculator.
Yes, the math.
Because a big part of the book is decoding the exact math of how these firms price a business. And there is a crucial distinction made right off the bat that I think trips a lot of people up. And that's the difference between enterprise value and equity value.
You really cannot understand private equity without understanding this distinction. It is the foundation of every single deal. Enterprise value is the value of the entire business to all its capital providers. So that's both the debt holders and the shareholders.
Right.
But equity value is the value that belongs only to the shareholders.
The book uses this incredibly relatable analogy for this, comparing it to buying a house.
It's a great analogy.
Yeah. If I want to buy a house, the enterprise value is the agreed upon sticker price. So let's say $1 million.
Okay.
But if that house has an $800,000 mortgage on it, the equity value, like the actual check I write to the seller so I can walk away with the keys, is only $200,000.
Oh, exactly.
I pay the equity, but I inherit the debt.
That translates perfectly to the corporate world. But to figure out that $1 million sticker price, the enterprise value private equity relies on a metric called EBITDA.
Oh, boy.
Yeah, it stands for earnings before interest, taxes, depreciation, and amortization.
That is a massive mouthful of financial jargon. I mean, why wouldn't a private equity firm just look at the bottom line? And why not just ask, hey, how much profit did you report to the IRS last year?
Well, net income, the bottom line you report on taxes, is heavily skewed by how a company is financed and what kind of tax strategies it uses.
This is noisy.
Very noisy. EBITDA strips all of that away. It is a pure measure of the cash-generating operational profitability of a business. It basically tells an investor, if we strip away your bank loans, your tax loopholes, and your accounting choices, how much cash does your core business actually spit out every single year?
But wait, the book makes a massive point that private equity firms almost never use a company's officially reported EBITDA. They use something called normalized EBITDA. Like, they seem to play detective with the numbers.
They absolutely have to. They are trying to find the true recurring baseline of the business. So let's say a founder of a family business is paying themselves $10 million less than a market rate CEO would demand just to keep profits looking high.
To make the business look better on paper.
Exactly. A private equity firm has to deduct that $10 million from the profits. Because when that founder leaves after the sale, the firm has to hire a real CEO at the market rate. The historical profits were artificially inflated.
Or the flip side, right. If the company had a warehouse flood and received a one-time insurance payout of $5 million, the firm strips that out of the profit calculations because it's not a recurring part of the business model.
Right, you can't rely on a flood every year to make your numbers.
That would be a terrible business plan.
Exactly. So once they have that normalized EBITDA, they apply a multiple to it to get the enterprise value.
Okay, so if the normalized EBITDA is $10 million, and businesses in that sector usually sell for a 10x multiple, the enterprise value is $100 million.
You've got it. But then comes the defining mechanic of the buyout world, the LBO, or leveraged buyout model.
Leverage. Debt. This is where the shadowy, ruthless Wall Street caricature comes from, I think.
Okay.
Slapping a ton of debt onto a company. So what does this all mean? Why is leverage so incredibly crucial to the math of private equity?
Mathematically, leverage magnifies returns. Let's go back to your house analogy for a second.
Okay.
You buy a $100,000 house entirely with your own cash. A few years later, the neighborhood improves, and you sell it for $120,000. You made a $20,000 profit on a $100,000 investment.
So that's a 20% return.
Right, which is decent, but not private equity number.
Yeah, they wouldn't get out of bed for that.
Exactly. Now imagine you buy that same $100,000 house, but you only put down $20,000 of your own cash, and you borrow the other $80,000 from the bank.
Okay, using leverage.
Right. You sell it for $120,000. You pay back the $80,000 loan. You are left with $40,000. You just turned your initial $20,000 investment into $40,000. You doubled your money.
Wow.
That is a 100% return on your equity, simply because you used debt to finance the purchase.
But the book points out that leverage isn't just a mathematical parlor trick to juice the returns. It acts as a profound discipline mechanism for the company, which, honestly, sounds like corporate speak for squeezing a rock for blood.
It certainly changes the culture of a company, that's for sure.
Right.
When a business has no debt, management can get kind of complacent.
Like they get comfortable.
Very comfortable. They might keep unprofitable divisions open for sentimental reasons, or let millions of dollars of inventory sit around gathering dust in a warehouse. They might even build a massive new headquarters they don't really need.
Because they have a massive cash cushion?
But when a company is saddled with significant debt from a leveraged buyout, that cushion completely vanishes. Management has to make large interest payments every single month.
Right, the bank wants its money.
They no longer have the luxury of being lazy with cash. The debt forces the company to become highly efficient. They have to liquidate that old inventory. They have to close the unprofitable division. It speeds up the timeline for necessary and sometimes painful operational improvements.
But you can't just rely on debt anymore, right?
Yeah.
The book explicitly points out that the era of simply slapping leverage on a company, waiting 5 years and getting rich is over.
Oh, completely over.
That was the 1980s. That was the massive $31 billion RJR Nabisco buyout, where financial engineering was basically everything.
Yeah, the easy wins from financial engineering are largely gone. Markets are simply too competitive now, and interest rates aren't always cooperative.
Right. Debt is expensive now.
Very. So if a private equity firm wants to generate those outsized returns today, they actually have to roll up their sleeves and make the underlying business fundamentally better. They have to build a better company, not just a more indebted one.
And this introduces the concept of operating partners. The book outlines 5 pillars of modern value creation that these operating partners execute: revenue growth, margin expansion, capital efficiency, multiple expansion, and deleveraging.
Right, the core playbook.
I can understand revenue growth, selling more stuff, margin expansion, cutting costs. But multiple expansion sounds like pure finance jargon.
Multiple expansion is actually one of the most powerful levers they have. Think of it like flipping a business model.
Okay.
Let's say you buy a regional family-owned burger stand. The market might value that kind of basic, unpredictable business at 3 times its profits.
Sure.
But if an operating partner comes in, standardizes the menu, builds a proprietary app for ordering, and creates a franchise model, that business is no longer just a burger stand.
It's a tech company.
It's a scalable food tech brand. The market might suddenly value it at 8 times its profits, even if it's currently selling the exact same amount of beef. The quality of the earnings has improved, so the multiple expands.
Wow. So they act as business architects. The book talks about them implementing zero-based budgeting. Instead of looking at last year's travel budget and adding 5%, every single manager has to justify their entire budget from zero every single year.
It is intense.
They bring in data scientists to rewrite pricing algorithms. They completely redesign supply chains.
They're turning a good, perhaps sleepy company into a highly optimized machine. They literally parachute in talent that a mid-sized company could never afford or attract on its own.
Here's where it gets really interesting, though, because reading this, I kept hitting a logical wall.
Okay, what's that?
If publicly traded companies have all the access to public capital markets, all the money in the world, and massive corporate resources, why does it take a private equity firm to fix these operational inefficiencies? Why don't the public companies just do this zero-based budgeting and supply chain redesign themselves?
This raises an important question, and the answer lies entirely in the structural incentives of the public stock market. Public markets are aggressively obsessed with 90-day quarterly earnings.
The quarterly earnings call.
Yes. Think about a public company CEO. If they announce to Wall Street, hey, we are going to completely overhaul our global supply chain and migrate our entire legacy tech stack to a custom cloud infrastructure.
Which is a good thing for the long term.
Right. But they say it's going to cost $500 million and our profits are going to look terrible for the next 2 years, but I promise we'll be stronger in year 3. What happens?
The stock price absolutely tanks.
The stock price plummets. Activist investors start circling, demanding share buybacks. The board gets nervous and the CEO likely gets fired before year 2 even finishes.
That's brutal.
Public company executives are trapped in short-term thinking because their survival depends on the next 90 days.
But a private equity firm doesn't have a quarterly earnings call.
Exactly. They operate with a 10-year fund structure. Their capital is committed by limited partners, the LPs we mentioned earlier, like pension funds for a full decade.
So they have time.
This structure allows the private equity firm to take a company private, pull it completely out of the glaring spotlight of the public markets, and execute these painful, expensive, multi-year transformations without worrying about a daily stock ticker. It is the luxury of patience backed by billions of dollars.
That makes total sense. They buy the time required to do the hard work. But to truly understand how this modern operational playbook is tested, the book takes us out of the comfortable Western markets and into a place where sophisticated finance collides with massive complexity and explosive growth.
Right, we are talking about India.
Yes, India. The history of how capital entered India is wild. The book starts with the 1991 economic liberalization, which finally removed the heavy state controls and opened the doors to foreign investment.
Which was a massive turning point.
Then you had a growth equity boom in the 2000s. And then, post-2010, an absolute startup revolution fueled by India's digital public infrastructure, or DPI.
The DPI is crucial to understand. We are talking about systems like UPI, for instance, zero-fee digital payments across the country, and Aadhaar, a biometric digital identity system for over 1 billion people.
It created this incredibly frictionless digital economy, but it's layered over an incredibly complex physical reality. And reading the book, this is where the traditional private equity playbook seems to break down.
Yeah, you can't just copy-paste the Wall Street model.
Because in the U.S., the model is usually a majority buyout. A firm buys 100% of a company, controls the board, and if the CEO pushes back on the new supply chain plan, they just fire the CEO.
Right, they have total control.
But the corporate landscape in India is completely different.
It is heavily dominated by family-owned businesses. In the Indian context, these founding families are known as the promoters. And these promoters are deeply, deeply tied to their businesses.
It's not just a job for them.
No, it is their legacy, their social standing. They are extremely reluctant to cede control to a foreign investment fund.
So the private equity firms can't just buy the whole thing.
Often, they can't. They have to take minority stakes, they have to inject millions of dollars of capital, and somehow drive all that operational mastery, the zero-based budgeting, the tech upgrades, without actually having ultimate legal control of the company.
And the day-to-day operations they are trying to fix are vastly different too. The book highlights the challenge of informal supply chains and incredibly complex working capital cycles.
Yeah, so a working capital cycle is essentially the time it takes to turn the money you spend on raw materials back into cash from selling a product.
Yeah.
In Western markets, this is highly standardized. But in India, a mid-sized manufacturing company might have to pay its factory workers every Friday in cash and pay its raw material suppliers up front. But the massive conglomerate buying their finished product might take 90 or even 120 days to actually pay the invoice.
So the business is constantly gasping for cash just to keep the lights on, even if they are technically profitable on paper.
Exactly.
Operating a private equity playbook in that environment sounds like trying to upgrade the engine of a high-speed race car while it's currently navigating a chaotic, completely unmapped street market.
Oh, wow. I love that analogy. It's so accurate. What's fascinating here is how this specific environment completely changes the job description of a private equity professional.
How so?
Well, in New York, you might succeed purely by being a brilliant numerical analyst sitting behind a complex financial model. But in Mumbai or Bengaluru, that spreadsheet will only get you in the door. You have to evolve into a diplomat.
Because you don't have absolute control over the promoter.
Exactly. You have to navigate really delicate family dynamics. You might be dealing with succession planning, trying to convince a patriarch to pass the reins to a daughter who went to business school, rather than a less qualified son.
Oh, man.
You have to practice deep cultural sensitivity. The book makes it very clear that many deals in India happen or fall apart based entirely on the relationship and the trust built over countless dinners between the founder and the investor.
It's incredibly personal.
The investor has to persuade the family to professionalize, to bring in outside management, to adopt transparent accounting, all while making them feel deeply respected and honored.
It really is corporate psychology as much as it is finance. But whether we are talking about navigating a family business in India or overhauling a software company in Silicon Valley, all of this intense relationship building, the operational fixing, the massive debt structuring, it all points toward one final defining act for the private equity firm.
The exit. Everything they do is reverse engineered from how they plan to sell the company.
This is where the private equity firm finally realizes the value they've created and returns the capital, plus the profits, to their limited partners. And the book breaks down a few ways this happens. You have trade sales, which is finding a larger corporation, usually a competitor, who wants to buy the business for its new capabilities, or the market share the PE firm just built up.
Right.
Or you have the IPO.
The initial public offering, taking the newly polished, optimized company back to the public stock markets. The exit is where the core thesis of the investment is proven right or wrong.
It's the final test.
It's the ultimate validation of that 5 to 7 year journey of active ownership. Did the operational mastery actually work, or did the leverage just weigh the company down?
Which brings us back to you, the listener. We started by asking what this industry actually does. Why should you care about this shadow capital? Because private equity is the invisible architecture behind modern capitalism.
It really is.
The efficiency of the logistics network delivering your packages, optimized by private equity. The security of the tech stack you use at your job, funded by private equity. They reorganize the supply chains of the brands you buy and restructure the clinics where you receive your health care.
They are everywhere.
It is an industry actively shaping your daily life, far away from the daily ticker tape of the public stock market.
It is entirely embedded in the global economy. But if we connect all of this to the bigger picture, it leaves us with a rather profound tension to consider.
What's that?
Private equity has become incredibly sophisticated. They are incredibly efficient at taking companies private, executing these painful transformations, and capturing the absolute greatest value creation years of a company's life behind closed doors.
Right, the hypergrowth years.
Exactly. They only return these companies to the public markets through an IPO once they are massive, mature, and stabilized. So what does that mean for everyday retail investors?
I see where you're going with this.
If the highest growth, most transformative years of a company's life cycle are now entirely locked inside private markets, everyday investors with a standard brokerage account are increasingly left with access only to mature, slower-growing public companies.
Wow.
The nature of who gets to participate in wealth creation is fundamentally shifting.
That really changes how you look at your own retirement portfolio. The biggest gains in the economy might be happening inside a room you simply don't have the key for.
It is a massive structural shift in how global capitalism operates today.
So, tomorrow morning, when you wake up on that mattress and you brush your teeth with a product distributed by a logistics firm backed by a buyout fund, just remember, the world around you isn't just happening. It is being actively managed, optimized, and leveraged from inside the black box.